So you think China is a bubble? Well, guess what? There are still trading opportunities, beginning with Baidu. Jim Cramer has the scoop. Welcome, Jim Cramer.
Produce, how are you?
Now, when you recommended Baidu on Stop Trading with Aaron Burnett, you got a lot of criticism shortly thereafter.
You know, a lot of people don't want to distinguish between stocks and companies, and a lot of my work on the market involves the notion that there's a great divergence over the short term between what a company's worth and what it sells for. We've seen this time and again. In the case of the Chinese market, we can all stipulate that the stocks are wretchedly overvalued. So what we do is we say, okay, well, look, we know that they're overvalued, but we want to profit from them. There's a whole class of money managers that says that's just impossible. When they're overvalued, and we can't touch them. No stock has ever gone down because of overvaluation. This is something that my friend Steve Einhorn taught me when I was at Goldman Sachs when he was research director. So what I'm saying here, and what my friend Patrick Schultz is saying is, look, do not try to say that it's cheap. Just own it, and own it in a way that makes it so you can make a lot of money.
So you're saying that you are buying on the expectation that the stock is inevitably going to go higher, right? So at what point do you give back some, Jim? At what point do you see signs of a bubble bursting?
Well, you know, I am a big believer that you never know when it's going to burst, which therefore is often interpreted as meaning you can't play. I think that what my strategy has been over time is to use options on these situations. I call it stock replacement. It means that instead of risking $360, maybe you risk $60. Now, you could say, well, Jim, $60 is a lot, but you could have started this strategy at 100 or 150 or 200, 250 or 300, 360. So each case, if you lost the 60, by this point, you're playing with the house's money anyway, so what? Now, it's intriguing to see how many people believe that there isn't a middle ground. They either think you're playing it because you think that they're cheap, or you're not playing it because you think they're expensive. And what I'm saying is I think they're wretchedly expensive, but I'm still playing them because the blow-off has often produced some of the best results.
Does the same go true with your other horsemen of China? When I mentioned you have Focus Media, China Mobile, and PetroChina.
Yeah, those are the ones that, you look at PetroChina, you look at it versus Exxon. It's pretty absurd. But again, I come back to the notion that absurdity is not a reason to not play. If you believe that what really matters is the integrity of the longer-term value process, you should still be able to be comfortable with my view, because I am saying that the longer term is bad.
Right.
I'm just trying to play the shorter term. By the way, two that are fitting the same bill are Las Vegas Sands, and very much so, and Wynn. They've become Chinese stocks. They're selling at 3 times their growth rate and 4 times their growth rate. That's a characteristic of the Chinese stocks. So they're obviously somehow, I know they're not supposed to be able to own anything else, but they're obviously finding some way to be able to invest in those because they are Macau. So I think ultimately what you have to make your peace with here, and what I felt so badly about the hedge fund manager who was angry at me, is that I agree with him. I just want to make some money off of the madness.
All right, Jim Cramer on how to trade a bubble. Thanks a lot, Jim, on Wall Street Confidential, only on thestreet.com TV. Stay tuned.